Hey guys, it's Coach Julie and welcome back to my channel, Making Sense Out of Your Dollars and Cents. Well, today again is my favorite day of the week and it is Wealth Building Wednesday. Yay! Woo! Listen guys, today I'm going to continue the conversation on retirement accounts. Since we are in tax season, I don't want this season to go by and you not take advantage of all of the things that you can do with your IRA or your 401k. So we're going to talk specifically about the differences between two types of IRAs. One is called a traditional IRA and the other one is called a Roth IRA. Now, first of all, you might be wondering, why do I even need to contribute to an IRA? It's extremely important, and I'll tell you why. Who else is going to take care of you when you get old? Not your job, not your boss. So you have to make sure that you are preparing now. As I said last week, if you're in your 20s, 30s, 40s, 50s, 60s, or even 70s, you can still take advantage of contributing to an IRA as long as you have earned income. So I get a lot of questions on what is the difference between a Roth IRA and a traditional IRA. Well, I'll tell you, depending on where you are in life, one can be better for you than the other. I would say if you were on the younger side, in your 20s, 30s, or even 40s, I would really strongly suggest that you get a Roth IRA, because a Roth IRA allows you to take out your money at the end of the retirement period, or when you retire rather, tax-free. Did you hear that? Tax-free. So even though you don't get the tax break up front like you do on a traditional IRA, you get the money tax-free. So if you have accumulated $1 million or $2 million or $10 million by the time you've retired, it comes out tax-free. So that's a huge, huge, huge thing. The big difference with a traditional IRA is that you take the tax advantage up front. So if you are contributing to an IRA or a 401k, you can deduct that money off of your taxes. It lowers your taxable income so that you actually end up paying less taxes. However, at the end, when you are retiring and drawing that money out for your retirement, that's when you pay the taxes. So again, if you've accumulated $1 million or $2 million or $10 million, you are going to pay taxes as you withdraw that money out of the retirement account. So again, if you don't care about taking a tax advantage now, definitely contribute to a Roth IRA. Now, I also get a lot of questions too about how about converting a traditional IRA to a Roth IRA. It depends again on where you are in the life cycle, how close you are to retirement, if that's going to make sense for you, because you can do it. But what happens is if you take a traditional IRA and convert it to a Roth IRA, you are going to have to pay taxes on the entire amount. So think about it, just for round numbers. If you have a $100,000 traditional IRA, you convert it to a Roth IRA, you're in an average tax bracket of about 30%. They are going to take 30% right off the top for the tax man, for the IRS, which is $30,000 out of your $100,000. So you have to decide if that's worth it to you. Again, if you're young enough and you can continue to contribute and make up that difference, it might make sense for you. But if you are much closer to your retirement, you can't make that money back, that 30% back, or whatever your tax bracket is. So may not be a good idea. Now, as always, I am a financial coach. I would encourage you, talk to your financial consultant, your investment broker, the person that handles the information at your job, or your 401k, your human resource person. But I can definitely help you and give you some direction in that area. If you're interested, please hit me up. I'd be happy to give you that. So now, another note with any type of retirement account is the money grows tax deferred. Again, what that means is while the money is in the account, you are not paying taxes on it. Isn't that great? You get to build this amazing savings and you don't pay taxes on it. So it doesn't matter how much it grows to, you don't pay taxes on it as long as the money stays in the account. So again, with your retirement account, You do not want to ever take it out before the age of 59 and a half unless you absolutely need it. And there are some very specific reasons why you can take it out without a penalty. But if you're just taking it out because you want to take that cruise or whatever, you are going to be penalized before the age of 59 and a half. So I encourage you, don't do it. That's the government's way of encouraging you to continue to save your money. And remember, your retirement is all about you. You're the one that's going to have to live. Most of us will spend half of our lifetime in retirement. Everybody nowadays is getting to be 95, 100, even beyond that. If you retire at age 60, you've got another 40 years in retirement. So you've got to make sure you're prepared. If you're not prepared and you have no idea where to start, I would encourage you, reach out to your financial consultant, reach out to your investment advisor, or reach out to me. I can help give you the direction on where you need to go and how you need to start. But don't wait. If you are not taking advantage of an IRA right now, you need to start today. Also, again, as I mentioned last week, you can still make a last year contribution into your IRA, which again will lower the taxable income that you have to pay. So if you have time to do that, actually you have time to do it because you have time up until the day the taxes are due to be able to make that happen. So I would encourage you, if you're looking for some more deductions or write-offs, contribute to an IRA for last year. Make sure it is designated as a contribution for last year, not this year, although you can do both. And if you want to know what those rates are and how much you can contribute, reach out and give me a call. Okay, that's my Wednesday wealth building tip for the day. We'll look forward to seeing you next week. Make it a great day.